All right, good evening. Thanks for taking the time to come watch our presentation today. My name is Alex Fometti. This is Joe Wavering, Matt Bender, and Michael Lafredo, and we are here from Miami University to present our research on Cintas. We're going to start with a brief initiation and a company overview before moving into an industry landscape, before settling on our valuation and kind of concluding with our risks and final recommendation. So moving forward, we see several key factors that will result in a neutral performance for Cintas moving forward. So the future opportunities for organic growth will be somewhat limited due to stagnant ad stops and route saturation. However, Cintas will continue their emphasis on cross-selling and diversified products, which, coupled with their commanding market share, which allows for economies of scale and possibility of bolt-on acquisitions, will allow them to continue their aggressive plan of returning capital, particularly with share buybacks. All of these factors lead us to our recommendation of Cintas Corporation as a whole, with a 12-month price target of $78, which represents a downside of 3.42% from the current share price, or Friday's closing share price, of $81.64, which is inclusive of 85 cents.
So now looking at what Cintas really does, we see that they're primarily in the business services industry, with most of their revenue coming from uniform rentals and ancillary product offerings. As we can see at the bottom, their stock has run up significantly over the past year, a large chunk of that happening within the past few months, mainly due to strong earnings. So taking a deeper look into the margins and revenue of the company, we see that about 52% of the revenue is directly from uniform rentals, and this is very significant to the company as this is their highest margin segment. Looking at their distribution routes, we see that Cintas is around 7,800 routes, and these routes, it's been noted in earning calls that they're starting to become a bit saturated, which makes it to the point that Cintas can't really add customers to the routes as effectively without adding new ones. And then taking a quick look at the contracts, we see that they're mainly for a duration of 5 years, and they're structured such that no majority of customers will expire at any one time. One of the significant events that recently happened with Cintas was their sale of their document management service to Shred-it in North America. This resulted in a $180 million sale in exchange for a 42% equity stake in the newly formed company of Shred-it. They also sold their document management services in the UK to Restore, and additionally they sold their document imaging and storage services to 3 companies for another $180 million. Really the main reasons they did this was because they wanted to focus on their core segments, but still have that exposure to document management just without having to devote a significant amount of time of management resources. And then taking a look at their capital usage, we see that Cintas returns capital to their shareholders mainly through share buybacks, with a large chunk of that program starting in 2011. They're still authorized to buy back around $960 million worth of shares. Taking a quick look at their debt levels, we see that Cintas likes to keep their debt relatively low at around 1.5 debt to EBITDA. So management is rather reluctant to lever up on this just to return capital to shareholders because they want to maintain their strong corporate credit rating.
So now we're going to look at the uniform rental industry overall. Cintas is the largest player in this industry with 30% of the revenue. There are 3 other major corporations that operate within North America, but outside of these 4 conglomerates, there are hundreds of other regional-sized companies that operate in specific areas and regions in the United States that constantly compete with these 4 larger companies for business and margins. They also provide the opportunity for potential acquisitions moving down the road, which Cintas says they are potentially looking for in the next few years. As I just mentioned, that the M&A activity within the rental industry has been somewhat stagnant as the past couple of years. Much of the focus has been focused on organic growth through cross-selling. This involves selling additional products and services to already existing customers on routes that trucks already drive. So this really drives margins and allows Cintas to pick up additional revenue by not expending as much cost as it would be to pick up a brand new route or a brand new customer separate from those routes. Another major metric within this industry is the rental net ad stops index. And basically what this is the net amount of jobs that are either hired on or let go of by customers of the company. and Cintas has said in their past couple of earnings calls that this index has been relatively flat for them. So if we keep going here, we see that the ad stops employment index has been constantly beating the year-over-year growth rate of the non-farm payroll. So this would indicate that industries that are that rent uniforms from companies like Cintas and their competitors, that this would be a positive sign for them. But if we keep looking further into that index, we see that a lot of that growth has been within the food services industry as well as construction. So while they do, Cintas has customers from these specific industries, they are not as they aren't as indicative of a very hard customer. So they aren't manufacturing, they aren't rental, and they aren't repair and maintenance. They aren't as heavy users of these uniforms. So this is a concern moving forward, especially as Cintas has already said that while the market rate has been beating it, their numbers themselves have been relatively flat.
Moving into our valuation overview, this is a summary of the different valuation methodologies we use. This red line on the chart represents our implied share price target of $78 and shows you how this relates to the implied share prices of the different analyses used. Starting with the multiples analysis, it's important to note that Cintas is trading at its highest PE ratio in the last 5 years. We believe this is indicative of the high EPS growth that Cintas has experienced over the past 5 years, which has been in the mid to high teens and as a result of these share buybacks. However, looking forward, we believe this EPS growth is going to drop off because of the different drivers we mentioned, and this will result in the stock trading down since the growth rate isn't as high. Moving on to the discounted cash flow analysis, we derived an implied share price using projected cash flows from the operating models that we implied. Using a WACC of 7.7%, implied a share price of $82 using an exit multiple strategy and $76 using the perpetuity growth method. The multiple used was 12 times EV to EBITDA in 2019, and the perpetuity growth rate was 2.75% starting in 2019. Finally, using a leveraged buyout analysis with the assumptions of an exit year in 2019, a sponsored target IRR of 15%, and a leverage ratio of 8 times 2014 EV to EBITDA, or debt to EBITDA, resulted in an implied share price of $75.
Now moving into a SWOT analysis, you can see, as we kind of highlighted during this pitch, Cintas' strengths include their large economies of scale, their extensive customer network, their strong cash flow generation, their experienced management. In order to kind of build on these strengths, they're looking to continue this industry trend of cross-selling, which we alluded to earlier, as well as looking for a possible bolt-on acquisition in a regional location. Some of our weaknesses would include our low involvement with the food services industry, which is currently the largest driver of net ad stops. So because of our limited exposure, we don't see the same gain in customers as perhaps another company would. And then also we have a minimum amount of debt, which leads to a less than optimal cost of capital. And then looking at some of the threats, about 10% of Cintas' revenue comes from outside of the U.S., and so fluctuating currency exchange rates is always a concern, although somewhat minor. And then there's also the possibility of increased OSHA regulation, which could affect Cintas factories and Cintas at home. There's also the threat of employee unionization, which we see as very low. And of course, the global macroeconomic situation could always take a downfall, in which case job numbers across the board would be affected. So in conclusion, we see the several key factors that we kind of touched on in the beginning and have moved through this presentation that would result in a neutral performance for Cintas. And we recommend them as a whole with a 12-month price target of $78, which represents a downside of 3.42% in the current share price of $81.64, which is inclusive of an 85-cent dividend. So thank you very much for your time, and we now open it up to questions.
Yeah.
You'd mentioned acquisition activity in one of your slides.
Mm-hmm.
Do you have a perspective on the pricing of acquisitions, and is pricing getting to a point where it's not accretive to the company?
Yeah, certainly. So Cintas hasn't really been that active in the acquisition space lately. And when they do move to acquire companies, it's to add on new products or geographic locations. And because they've become so widespread, they don't really have many opportunities to add on new domestic locations. And another reason that management has been unaggressive in pursuing acquisition strategies is because valuations within this industry are so strained. Cintas isn't the only one of its competitors trading at a very high PE ratio, and with valuations that high, it isn't necessarily financially viable for them to go in and buy other companies.
And on the shredded change, obviously, do you or management, would you have recommended to maintain a stake, or would you have thought that they should have just completely walked away from the deal? I mean, as far as get out of it, and how'd you discuss that as a team?
I mean, it's definitely an interesting take that they took. Spending multiple transactions, multiple companies trying to divest that while still keeping retaining 40% in shredded. I think it was they mentioned that the growth wasn't there, but they wanted to still be exposed to that. They still wanted to be the customers still need paper shredding and still need document management. So I think that they wanted to hold on to that just as a reassurance to their already existing customers that they're really close with shredded and they're both based in Cincinnati, and so I think that moving forward that they wanted to keep that 42% just as almost as just an investment, and just to see they still got they got a lot of money for it. They returned a lot of it to shareholders. They just want to be exposed to that portion of business services.
Yeah, just a quick addition to that. Shredded has the experienced management team that we spoke about earlier. Cintas just necessarily, their core segments are really uniform sales, first aid, fire safety. So when looking at that, it seems as though Cintas didn't want to spend so much time and resources of management to try to improve their document shredding business when they could just simply pass it off to some other company with more experience in that and see get that 42% stake in the $180 million cash.
And a follow-up, is there, looking at the company as you have, is there, just assuming you guys were the manager, would you, and you said, okay, we want to grow this company, where would be the top of the list for your, either a bolt-on acquisition or some new strategy that you, maybe as a team, talked about internally?
Yeah, so looking at some of Cintas's fastest growing segments, we see that most of the growth in just terms of sheer percentage comes from first aid, fire safety. They recently made a very significant acquisition in that. And we saw that as a move towards that. Granted, it's only around, it's in the mid-teens percentage of their revenue, but we do see that as a growth opportunity moving forward.
Additionally, to address the idea of acquisitions, because Cintas is such a large company, they're really able to leverage their distribution network, so they can go out and possibly buy a small bolt-on acquisition to acquire new products, and then achieve great revenue synergies by taking that company that was probably focused on a small geographic market and blasting it out through all their channels to a wide geographic area.
So how did you guys look at costs in your modeling and thinking about out years earnings, and what are some of the key drivers there?
So when we look at costs here, we kind of referred to this a couple times, the route saturation. So Cintas has been driving down costs by trying to add as many diversified products as they can. So if the trucks have to run their same route, they may as well try to bring as many products and services as they can on that route, because the costs are more fixed in that sense. But that's what we're kind of saying. At this point, we don't really see costs going down too much more, particularly in the rental services section. There would be a slight down step, but we can't really add that much more once they become fully saturated. There's only so much you'd have to add new routes, in which case you're paying significantly more for new customers than you were when routes weren't saturated.
And Cintas is adding, they have mentioned that they are getting to that saturation point where they're going to have to make the additional investment to add further facilities and further routes. Their CapEx has spiked this fiscal year, and they project the next 2 fiscal years as they're implementing SAP ERPs into their uniform rental services, and they don't think that's going to be implemented until 2017 at the earliest. And then additionally, they are originally supposed to build facilities starting this fiscal year, but they haven't decided on any specifics yet, so they're pushing that out. So we see, very, very quickly here, we're getting to the point where they will not be able to, again, saturate routes and cross-sell as much because there just won't be enough capacity in that regard. And then another thing on costs is, I should mention, is that their safety and or that segment, since it's the newest segment, their SG&A costs are high initially, and those have been stepping down in the past few years and will continue to step down until SG&A costs are in line with the rest of the segments.
The 15% sponsor target IRR that you guys use in the open market, how does that compare to the discount rate you guys use for your DCF model?
So it's the discount rate that we used was 7.7%, so it's twice as high.
In the uniform rental business, I believe they have a wide range of customers in terms of size, from very large customers to very small. Is there any measurable difference in terms of either the profitability or the economic sensitivity of big versus small? And is there any particular trends? Is it big getting bigger or small getting bigger historically and projected going forward?
Well, Cintas, they are very reluctant to, again, disclose the size of all their customers and, the industries, the amount of industries that they're involved in, just for competitive reasons. But one thing to mention too are those contracts and how they are, since they're 5 years long, they're able to kind of get through any downswings that may negatively affect the economy as a whole. Their EPS decreased from just in the $2 per share to, I think they dipped in 2009 at like $1.20. So it was not an immediate, a long-term effect, and they bounced right back up. They have that capacity to serve large and small customers, but there's no management has not disclosed, or there's no way to figure out, what the profitability would be for a large customer versus a small one.
Another important aspect to address with the contracts is the way that they're structured. There are set fees for uniforms, and as you buy more uniforms from Cintas, so say your company doubles in size over the next 3 years, there are provisions for you to scale up your renting from Cintas, but these contracts also have a minimum revenue requirement. So even if you aren't actively using uniforms from Cintas, you still have to be paying them some amount of money for the duration of the contract.
With respect to the contracts, such a large market share, why don't you think they've been able to build in an increase in price greater than CPI?
Yes, so they have been, exactly to your point, they have been around, that CPI index as of late. However, the past couple quarters, they have been beating because of pricing increases. So they've seen a lot of strength, at least not in their net add stops numbers. They aren't hiring anymore, but companies are willing to add on more services and willing to pay just a little bit more maybe for that same service because the economy's better, those businesses are performing better. So Cintas has been able to, in the past, I'd say 6 to 12 months, been able to really increase, I think, the prices faster than historically because of the overall strength of the economy and that of their customers.
How did that play into your valuation going forward?
Well, we see, again, that the pricing is tough to predict, but we saw the pricing just probably going right along with CPI because, right now, revenue is growing at, the rental revenue is at, 6-7%, and we see that, continuing for a certain amount of time, then leveling off as they, again, become so saturated that they're going to need a lot more capital expenditures to be able to acquire new customers.
What do you guys think about in terms of them overpaying for their acquisitions? What was the discussion you guys had going on, if any?
So, judging from management's conservative approach to acquisitions over the past 5 years, they really haven't been that active. And because they command such a large market share, there isn't really a necessity for them to take unwarranted risk. So I think they're definitely spending a lot of time in evaluating all these different situations. And another important aspect of Cintas is on their board, they have a board member who works for Booz Allen's M&A practice. And we believe that he provides them with a lot of strategic advice in terms of acquisitions, and that having him on the board provides the company with a certain insight into acquisitions and how they can be profitable for them. And we really like that he's involved with the company and can maybe hold back the reins if management gets excited about an opportunity, but it isn't necessarily financially viable.
And just to add off that, we already mentioned that valuations in this industry are at, a very high level. So it's kind of, the pickings are few and far between for Cintas if they want to possibly go after somebody. They've mentioned that they've said that they were looking for an acquisition. They just don't know where or what industry. But they have the capacity to take on a lot more debt. They can lever up to 3 times. They have a revolving credit facility that they can lever up 3 times EBITDA, and they're at half that right now. So if something falls into their lap, they're able to pull the trigger like that. But as of now, it's been a lot of we're looking, and we're maybe looking for valuations to settle back down before we actively pursue it.
That's all the time we have. Thank you, Miami. Great job.